The Bank of Canada announced that they're ending quantitative easing in Canada, and they have moved up their timeline with respect to when interest rates could go up. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Welcome back. Today we're discussing the Bank of Canada's recent decision and their monetary policy report and everything that comes along with it, including them moving up the timeline with respect to raising interest rates. But before we get into the video and get into all the details, do me a quick favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. All of those things do me a huge favor with respect to growing this channel and getting this sort of information out to more people just like you. And don't forget about our race to 25,000 subscribers, where one lucky winner is going to win $5,000 when we hit 25,000 subscribers just for being subscribed to this channel. But in order to win, you have to be subscribed. So go ahead and click that subscribe button. It's free, it's easy, and it's definitely worth it. So let's jump into the video here and talk about the major changes with the Bank of Canada today. First and foremost, the end of quantitative easing. So what that means is that the Bank of Canada is no longer going to be buying excess bonds, and they're basically going to just buy enough to maintain the levels that they have currently. So what that means is they're going to buy about $4 to $5 billion worth of bonds on a monthly basis. They're now reporting this on a monthly basis rather than on a weekly basis. And they are basically just going to replenish the bonds that are coming up for renewal at that point in time. So this is a huge change because at the beginning of the pandemic, they were buying up to $5 billion per week in bonds. And now they're only going to be purchasing $5 billion per month. And that basically means that quantitative easing, the aspect of the Bank of Canada that they use in order to spur on the economy when interest rates are so low that they don't want to move the money forward, is somewhat over. And, you know, it's really interesting because when you take a look at the Bank of Canada and you take a look at their monetary policy report, which is right here, you go in and you take a look at the very first page, and the first page is Canada's inflation control strategy. And it goes through and talks about things like inflation, monitoring inflation, inflation targeting, and it talks about the monetary policy tools that they have. And the first policy tool that we're all very much aware of is interest rates. The second one is quantitative easing, because that's been a lot of the information that we have been given in the last couple of years. And the third one is negative policy rates, which we haven't gotten to yet and very likely won't at this point. At least we hope we won't. If we do, it means that things got really, really bad in the future. So nobody is hoping for that. But the fourth, and this is the one that is the most interesting, is this one right here, which is guidance on the future evolution of the policy rate. So what this means is just them communicating what they may or may not do. And that's what they are doing right now. That is the other big change. This is them moving up the time frame with respect to when they may increase interest rates. Previously, it was communicated that the Bank of Canada wouldn't start increasing interest rates until the second half of 2022. That meant sometime July or later. Now they're communicating that due to the decrease in the output gap, that it could be as soon as the middle quarters of 2022. So what that means is anytime between April and the end of September. So here's what's interesting. In economics, we are taught that sometimes communicating potential changes is just as effective as actually making them. So moving up the timeline can have a similar sort of effect as increasing the interest rates themselves. And in this communication, what they're saying is we're ending quantitative easing, but we're going one step beyond that because that was expected. And we're saying we may move up the time frame with respect to increasing interest rates. So that can have a pretty big effect on the economy and could in itself start to slow down inflation. Now, they still may start increasing interest rates in the second half of 2022, but they've given themselves the leeway to do it earlier. And ultimately what this comes down to is the output gap. So the output gap is really simple. It is the difference between the potential output in the economy and what the output is now. And they've revised down their estimates for the output gap as of right now. And the reason they've done that is because, quite frankly, they aren't seeing as much excess supply in the economy as they thought previously was there. That's largely due to the supply chain issues. So this is a number we need to watch, is the output gap. And if the output gap starts to get closer and closer together and there's less excess available output in the economy, that means the economy is essentially at full recovery, and that's when interest rates could start going up. Now, the Bank of Canada will inform us of this on a quarterly basis, so we'll get at least one more report before April, and then we'll get a second report in April, and if the output gap is still there in April, we've got a few more months left with respect to super low interest rates, and if it is closed by April, then we're probably going to see higher interest rates. Now, a few other things here and a few other comments that they made with respect to this whole conversation. And by the way, I'm going to jump in here real quick and just show you, if you want to read any of this stuff, you go to the Bank of Canada's website, you can pull up the full monetary policy report. It's 33 pages long. Yes, it gets a little boring, a little bit dry, but if you're the type of person that likes detail, this is absolutely for you. Now, if you don't want to read the full policy report, you can see the policy report press conference opening statement. This takes about 3 minutes to read. It goes through and it talks about the highlights of the policies and the changes that they've made. And if you want to go and take an even easier approach to reading this, check out either BNN Bloomberg, look at their article with respect to what's happening here. Obviously, they do some really great reporting. And if they aren't quite your speed, you can go and take a look at the Globe and Mail. Now, I'm not sure if this is behind. Yes, it is behind the paywall for Globe and Mail subscribers. So BNN Bloomberg's is obviously easier to access, but if you want to get some more in-depth reporting or you've got that Globe and Mail subscription already, you can go and take a look at what they're saying with respect to the announcements today and the future direction of the Bank of Canada. So I want to show you that, but then I want to get into a few other highlights here. So one of the big things they're saying here is that there's significantly more volatility than normal in the markets. So why they're talking about there being more vulnerability than normal is because obviously things in economics change, right? You can do all the forecasting that you want in the world, but then all of a sudden, boom, financial crisis hits, boom, pandemic hits, boom, transitory inflation turns into supply side issues and upward pressure on prices across the globe. You know, we can't get things shipped. We can't get computer chips. All of these things were things that were not expected. And when we talk about economics, we're making predictions based on the information that we have and the best information that we have. And with volatility, with the Delta variants, with things that could come up in the economy that could alter what the forecast is, that means that this could change rapidly over the next quarter or 2 quarters or 3 quarters. So this is all based on the best guess. The other thing that they've pointed out here is that wage pressure remains moderate. So in other words, we've got inflation, higher priced goods. We've got, output coming up to 5%, which is really good. We've still got an output gap, not so good, but wage pressure has been low. And what that means is that wages aren't going up as much as you would normally expect them to in a high inflation environment. What that tells us is that as soon as the supply side issues start to go away, we may see lower inflation rates coming as a result. And think about it this way. With respect to the supply side issues, this is like a traffic jam on the way to work, right? We've got all of these ships and there's been an accident and they're all waiting to get to the destination. And because things have slowed down, they aren't able to get into the ports and they end up in this traffic jam. And over time, eventually, just like a traffic jam, the police show up, the ambulances show up, the fire trucks show up, the tow trucks show up, and eventually the mess gets cleared away and slowly but surely things go back to normal on that roadway. Same thing for the supply issues, especially with respect to shipping containers. So this is just something that we need to see work itself out. It's taking a little bit longer than expected to work itself out. Nobody can predict that. And as it starts to work itself out, we'll start to see what happens with that output gap as we get more materials so that we can produce more products. That output gap should go down. And that's when you can start expecting interest rates to go up. Now, the question is, and the question I know I'm going to get in the comments, so I'm just going to go ahead and address it, is does that mean that we should start locking in interest rates? Well, no, not necessarily. If you are the type of person that absolutely does not want to take the risk and you're the type of person that won't be able to sleep at night with a variable interest rate, then yeah, lock in. Do it for comfort. But if we're looking at actual interest rates and we're looking at what's happening, again, this is a highly vulnerable situation and we may not see interest rates actually go up in April. It may take till July. And obviously the Bank of Canada has left that on the table by saying in the middle quarters. So what they've said is we may do it earlier, but really what they're saying is it could be second half of 2022 as well. Could even take longer than that. And of course, there's always that chance that it could happen significantly sooner, depending on what's going to happen in the economy. But here's the reality. It looks like inflation is going to stay high until the end of 2021 and into 2022. We need to close that output gap, and it's hard to tell when that output gap is going to be closed. With respect to your mortgage, you've still got a significant amount of time, at least 6 months, to be able to save on your variable rate mortgages, likely longer than that. And even if they do increase interest rates, you're still going to be saving for at least the next 4 interest rate increases. And then you've got 4 more interest rate increases after that before you need to start worrying about even being break even. And if none of that made sense to you, I'm going to link up the video that explains it all right here from 2 days ago, where we talk about how even if in the worst case scenario we see 8 interest rate increases by the end of 2023, you're still in a position where you would be break even if interest rates go up that much versus a fixed rate mortgage. So check that video out if you haven't already seen it. And overall, if you want to know more about the variable versus fixed rate strategies, if you want to know why we are a big proponent of that, you can get my book right now for free, The Mortgage Millionaire. Just go to mortgagemillionaire.ca. I go in depth and I talk about the Moshmalevsky study out of the Schulich School of Business that talks about floating versus fixed rates and why even in rising interest rate environments, floating rates, variable rates tend to make more sense. And in this case, right now, you can still get a variable rate for 1% lower than a fixed rate, which means there's still a pretty significant amount of savings to be had. If interest rates go up rapidly, we always have the option to lock into a fixed at some point. But my guess is that we're going to see far more vulnerability, far more variability in the economy over the next couple of years. And a straight shot up in interest rates is somewhat safe to assume isn't on the near-term horizon. So lots happening with the Bank of Canada today, lots happening with interest rates. Obviously, it's an interesting time to have a mortgage. It's an interesting time to be an employee or a business owner. Just an interesting time to be alive. And realistically, all this comes down to is making sure you have the right strategy for the worst case scenario and making sure that you're comfortable with the decisions you've made from a financial perspective, both from the perspective of what interest rates look like now and what they could look like 2, 3, 5, and 10 years down the road. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers, and we'll see you on the very next one.